Sri Lanka finds itself at a critical juncture, facing a pivotal economic crisis in mid-2025. The challenges are multifaceted and deeply rooted, requiring careful analysis and strategic action. This crisis is significantly marked by persistently high interest rates and an overwhelming burden of public debt, creating a complex web of financial constraints. To combat inflationary pressures, interest rates remain elevated at 12 to 14%, a figure that has significant repercussions across the economy. This high interest rate environment is a tough but necessary move implemented by the central bank to control inflation and stabilize the currency amidst global economic volatility. However, this monetary policy comes at a cost, making borrowing considerably more costly for both businesses seeking expansion and consumers managing their household finances. The increased cost of capital is effectively stifling potential growth and discouraging new investment, creating a challenging environment for economic expansion. Adding to the strain, the debt-to-GDP ratio is projected to reach a concerning 115%, highlighting the magnitude of the country's debt obligations. This level is far above what is considered sustainable by international financial institutions, raising serious questions about long-term economic stability. A significant portion of this debt is owed externally, exposing the country to fluctuations in foreign currency exchange rates and increasing overall financial vulnerability. A large portion of government revenue is consumed by servicing this substantial debt, leaving fewer resources available for essential public services. Consequently, critical sectors like healthcare face budget cuts and underfunding, impacting the quality and accessibility of medical services. Similarly, education suffers from reduced financial support, potentially affecting the future workforce and the nation's long-term competitiveness. Investment in vital infrastructure projects is also curtailed, hindering economic development and future growth prospects. As a result of these combined pressures, economic growth remains sluggish and below potential. Current forecasts project a growth rate of just 1.5% for 2025, a figure that underscores the severity of the economic challenges. This anemic growth rate reflects deep-seated structural issues within the Sri Lankan economy that require comprehensive reforms. Consequently, for investors considering opportunities in Sri Lanka, the current environment presents a high-risk proposition. Navigating this landscape demands extreme caution, thorough due diligence, and a commitment to a long-term investment perspective. Yet even within this undeniably challenging and uncertain economic context, carefully considered and strategic investment opportunities may still emerge for those who possess the expertise and willingness to navigate the inherent risks. A comprehensive understanding of the complex interplay between high interest rates, the burden of heavy debt, and the constraints of slow economic growth is absolutely crucial for making informed and responsible investment decisions in Sri Lanka's current economic climate. The future trajectory of the nation hinges significantly on the effectiveness of its strategies for managing these multifaceted economic pressures. The stakes are exceptionally high, impacting not only the financial well-being of investors but also the daily lives and future prospects of Sri Lankan citizens. The coming years will undoubtedly serve as a critical test of the resilience and adaptability of Sri Lanka's economy in the face of persistent challenges. Ultimately, only those individuals and institutions with a clear and nuanced grasp of these complex economic dynamics can realistically hope to navigate the challenges and achieve success in the Sri Lankan market. Key economic indicators reveal the depth of Sri Lanka's crisis. GDP growth is expected at just 1.5% in 2025, a sharp slowdown from pre-crisis years. Inflation, though down from 2022 highs, is still projected at 8 to 10%, eroding savings and complicating policy. Unemployment hovers around 6.5%, with youth unemployment even higher, signaling social strain. The public debt-to-GDP ratio at 115% and a high external debt service ratio highlight severe fiscal vulnerability. These numbers point to significant sovereign risk and limited government flexibility. For investors, the message is clear. Returns must be weighed against persistent inflation and fiscal instability. The economic environment remains fragile and uncertain. Caution is paramount for anyone considering investment. High debt and interest rates have trapped Sri Lanka in a vicious cycle. The government's borrowing needs push up interest rates, making debt service even costlier and crowding out private investment. Banks prefer lending to the government over businesses, starving the private sector of credit. Households face expensive loans, curbing spending and demand. Persistent inflation further erodes purchasing power, forcing families to cut back. Businesses shift from growth to survival, delaying investments and cutting costs. This cycle leads to layoffs, reduced production, and a shrinking formal economy. Breaking free requires bold policy action and structural reform. Until then, growth will remain stunted and opportunities limited. The challenge for policymakers is urgent and immense. Sri Lanka's banks are under pressure, heavily exposed to government debt and rising private sector loan defaults. Fiscal fragility is acute. Tax revenues barely cover interest payments, forcing deep cuts to public spending. The government's ability to stimulate the economy is severely limited. The export sector faces mixed prospects. Currency depreciation helps competitiveness, but inflation and global slowdowns threaten gains. Infrastructure projects have stalled, hurting both short-term growth and long-term competitiveness. Deteriorating infrastructure raises business costs and deters investment. Reviving exports and infrastructure is critical for recovery. Public-private partnerships may be key to restarting growth. The financial system's stability hangs in the balance. Sri Lanka's crisis is rooted in years of debt-fueled growth and fiscal mismanagement. Unfunded tax cuts and abrupt policy shifts like the move to organic agriculture weakened the economy before external shocks hit. The COVID-19 pandemic devastated tourism and strained public finances. The war in Ukraine spiked import costs, pushing the country into default in 2022. Loss of access to capital markets triggered currency collapse and hyperinflation. These events exposed deep governance and structural flaws. Understanding this history is vital for investors assessing future risks. Sustainable recovery depends on addressing these core issues. Sri Lanka's path to economic recovery is intricately linked to a stringent reform program, one that is backed and guided by the International Monetary Fund. This program is not just a suggestion, it's a necessity. Fiscal consolidation is absolutely central to this recovery effort. It's about getting the nation's finances in order. This involves raising taxes, significantly broadening the tax base to include more contributors, and substantially improving collection efficiency to ensure that owed revenues are actually received. All of these measures are essential to achieve a primary surplus, indicating a healthier financial standing. The central bank is committed to maintaining relatively high interest rates as a tool to aggressively control inflation, carefully balancing the need for economic stability with the eventual need for monetary easing to stimulate growth. Complex debt restructuring negotiations are underway with a diverse array of international creditors, with the primary aim to secure substantial debt relief and restore long-term financial sustainability for the nation. Success here is absolutely critical, because without it, achieving lasting economic stability will remain frustratingly out of reach. Broad structural reforms are targeting inefficient state-owned enterprises, improvements in overall governance, and creating a more attractive and competitive business climate. Trade liberalization and proactive investment promotion efforts are key priorities in fostering sustainable long-term economic growth. Effective implementation is absolutely everything, because without consistent follow-through and diligent execution, even the best-designed reforms will inevitably falter. The comprehensive reform agenda is undeniably ambitious, but it remains absolutely essential for a full and lasting recovery. The decisions and actions taken in these next critical steps will ultimately determine Sri Lanka's long-term economic future. For investors, Sri Lanka in 2025 presents a complex landscape. It's a high-risk, high-reward proposition, demanding careful consideration and strategic planning. The biggest risk is reform failure. Any backsliding on promised reforms could derail the fragile recovery and severely impact investor confidence, potentially leading to capital flight. Debt restructuring outcomes remain uncertain, with ongoing negotiations and potential for unfavorable terms. Political instability is a constant threat, with the potential for policy shifts and disruptions to business operations. External shocks, global recessions or commodity price spikes could easily disrupt progress and exacerbate existing vulnerabilities. These external factors could easily disrupt the nation's progress towards economic stability. Given these risks, investors must demand a significant risk premium to compensate for the inherent uncertainties. Yet, depressed asset prices offer potential for those with patience and a long-term view, willing to ride out short-term volatility for substantial future gains. A successful reform and debt deal could unlock major gains, positioning Sri Lanka for a period of sustained economic growth. Sectors like tourism, renewable energy, and IT hold promise, offering attractive investment opportunities. The country's strategic location and skilled workforce are long-term strengths, providing a solid foundation for future development. Due diligence and risk tolerance are essential for navigating this complex environment. Sri Lanka's turnaround story is possible, but only for those ready to weather volatility and embrace a long-term perspective. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart. Trade.